Our next speaker is dialed in to India. He has been publishing his renowned weekly investment report, Greed and Fear, since July 1996. He has been ranked #1 equity strategist in the Asia Money polls between 2002 to 2004 and 2006 to 2018. Prior to entering the investment business, he was a financial journalist. He worked for the Hong Kong-based Far Eastern Economic Review between 1982 to 1984 and The Economist between 1984 to 1994. During this period, he was both the New York and Tokyo bureau chief. He was also the author of 3 acclaimed books while at The Economist: Boom and Bust, The Rise and Fall of the World's Financial Markets, published in 1989, The Bubble Economy, Japan's Extraordinary Speculative Boom of the 80s, and The Dramatic Bust of the 90s, published in 1992, and The End of Japan, Inc., and How the New Japan Will Look, published in 1994. In conversation on the phone line with Motilal Oswal Asset Management Company fund managers, Siddharth Bothra and Manish Sontalia, please welcome the Global Head of Equity Strategy at Jefferies, Mr. Christopher Wood.
Yeah, hi, Chris.
Hello.
Okay. Yeah. So, yes, Chris. Yes, Chris. Right. So, thanks for joining in out here. It's a global investor summit that we are having. The caption of this conference is "Don't Bet Against India," and we got this caption from a recent Berkshire AGM where Buffett said that don't bet against America. In that backdrop, what we have seen is that obviously Indian economy has also gone down significantly after the country went through a lockdown. And the markets have reacted, quite the opposite. We saw the markets plummet some 33% in the month of March. And then the markets have bounced back roughly 40% from their all-time lows. I mean, if the economy is not doing that great, what makes sense that the markets have reacted the way they have? And, what are your base case, worst case, and the best case as far as India is concerned?
Okay, well, thank you very much for having me. I hope everybody can hear me. I'm going to start with some opening comments, which will basically be primarily on the global U.S. situation. And then I'm happy to take questions, including our more India-focused questions. But I think I'll start with an overview of the big story of this year, which is the COVID-19 crisis. And I should make it clear from the start that my basic view on this pandemic crisis is that the government reactions to deal with it have been over the top, in the sense that I think governments panicked and have imposed a massive fiscal monetary stimulus, which is out of all proportion to the actual pandemic itself. Because while it's obviously unfortunate, this pandemic only hit the older demographic, so it makes no sense to shut down all these economies for a virus that only really, where the impact is only really confined to a small part of the population. And it makes even less sense in a country like India with a young demographic and where you don't have the extensive welfare states you have in America and Europe. So you should understand that my basic view is that the lockdown has caused more damage to human welfare than the virus itself. Now, I will admit, in the early days of the pandemic, there were genuine concerns that hospital systems would be overrun and that was the reason for the lockdown. But as it became clear the hospital systems were not being overrun, in my view, the approach could have changed. So it's quite clear why markets collapsed in March, because in January, February, Wall Street correlated markets were ignoring the pandemic because the unspoken assumption was that this was a pandemic which only basically impacted East Asian and Chinese people. That was the unspoken assumption. So it was a real shock to the world when the pandemic showed up in Europe, in countries like Europe, Italy. And so then we had the collapse. But since mid-March, we've had this very powerful rally, which has first of all been driven by the incredible monetary easing launched by the Fed. And most importantly, the Fed has signaled that it was buying corporate bonds, which caused the credit spreads to come down, and that was the originator of the rally. And since then, we've had what I call the reopening narrative. And markets have been responding positively to more and more evidence of reopening. So that's where we ended at the end of last quarter. What I'm saying in my new quarterly, I'm saying, and this was published this week, my new quarterly is called The Pandemic Prognosis. I'm saying equities can continue to rally on the reopening dynamic, while governments and central banks will remain wary of removing stimulus prematurely, since they remain hyper-focused on the deflationary impact of the lockdown. And I'm saying the main risk to equities in this quarter we have just begun is that V-shaped recovery expectations suddenly return with a vengeance, yield curves steepen, and concerns rise that the Federal Reserve and other central banks are too easy. So in my view, that is the risk in this quarter. We get more and more reopening, cyclical activity picks up, and given this massive stimulus launch, particularly in America and Europe, there's suddenly a concern that monetary conditions are too easy. And in that environment, cyclical stocks will do better than the growth stocks, because the cyclical stocks will rally on the V-shaped recovery expectations, but the growth stocks will be vulnerable to concerns about monetary tightening. However, I'm not a doctor or epidemiologist, so what if my base case is wrong? Because my base case is that the virus will essentially burn itself out and will progressively become less virulent. Well, let's say I'm totally wrong and the feared second wave really materializes. So what I say there, conversely, if the feared second wave materializes, credit problems will intensify and the risk will rise of a debt deflation cycle globally. But this will not lead to renewed across-the-board lockdowns, since it is now realized that the negative impacts on the economies and people's general livelihoods caused by the mandated cessations of activity are a bigger negative than COVID-19 itself. Meanwhile, such an outcome will lead to reactivated G7 central bank easing, providing support to equities. So in my view, in a second wave, you'll get a debt deflation concerns, because if we get a second wave, what becomes a liquidity event will become a credit event, because the authorities won't be able to continue to provide bridge financing, and that will lead to renewed deflationary concerns, and that will trigger a whole new wave of central bank easing, which in turn will support equity. Third point, let's say, so in my view, either way, V-shaped recovery, equities will rally, but on a V-shaped recovery, good news will in due course become bad news because the markets are worrying about tightening. Whereas conversely, if we have the feared second wave, our markets sell off, then bad news becomes good news because it leads to more Fed easing. My next comment, I'm saying long-term government bond investors who do not want to be locked into currently ultra-low or negative bond yields should reallocate their money out of the G7 world with a preference for Asian sovereign credit, and in particular Chinese sovereign bonds. There has continued to be a remarkable lack of stimulus by China in response to the pandemic, in stark contrast to the extreme fiscal and monetary policy measures which have been adopted in the Western world. So in March, I launched a sovereign bond portfolio, which I'm saying is a better way to invest in fixed income than to invest in a G7 government bond index. And my recommended sovereign bond portfolio is only in Asian local currency government bonds. I have a 50% weighting in the Chinese 10-year, 20% weighting in the Singapore 10-year, 20% weighting in the Indonesian 10-year, and a 10% weighting in the Indian 10-year. So far, my portfolio is outperforming G7 bonds quite significantly. I've got the latest performance data in the most recent readings here I published yesterday. So that's the view on fixed income. There's no point owning Western government bonds if we've got to lock in the bond yield. Next point, renewed fears of a Cold War between America and China look exaggerated in the short term, since the Trump administration still seems committed to securing phase 2 of the trade deal before the U.S. presidential election in November. Longer term, U.S.-China relations will hinge on whether the national security lobby seizes control of the policy agenda in Washington. That agenda is in direct conflict with the interests of America's financial and technology sectors. So I included that bullet point in my quarterly because there's a lot of concern about the U.S.-China relationship with new Cold Wars. Those concerns are legitimate, but in my view, things won't get bad. Well, not going to get bad under a Trump presidency because I don't believe Trump himself is committed to the national security agenda. Final point, which I think is relevant for everybody, is on gold. I'm saying gold remains more important than ever as a hedge, either against the return of inflation or against the onset of debt deflation and the resulting collapse of the US dollar paper standard as the Fed becomes ever more extreme in its efforts to reflate. Velocity will remain the key variable to monitor in terms of if and when the long-term downtrend in the turnover of money increases. So we've been in a disinflationary era since Paul Volcker, former Fed chairman, cranked U.S. inflation in the late 1970s by implementing extremely high real interest rates. All the time since the mid-1980s, I have had a disinflationary stroke deflationary view of the world. However, I think my base case is that historians in future will view the COVID-19 pandemic as the catalyst which brought to an end of this disinflationary era, because in my view, these policies have been so extreme. The likelihood of them trying to fix government bond yields in the Western world raises the base case has become that we are now at the beginning of the end of the disinflationary era, and investors now need to start thinking in terms of the bull market in long-term government bonds ending, which means equities will outperform, but it also means you have to own gold as a hedge. What's interesting about gold last quarter is that May and June are normally very bad months for gold. Gold was extremely resilient during the cyclical rally we saw last quarter. Gold stocks massively outperformed gold bullion, which is a very good signal for gold. And gold at new highs in every major currency of the world, again, except the US dollar. What's also interesting about how well gold did well last quarter, even though there's no buying demand from India. So that makes the gold performance even more impressive. So my global portfolio for US pension funds, I have a continuing 50% weighting in gold, 20% weighting in gold mining stocks, and 30% weighting in Asia ex-Japan stocks. That portfolio includes some Indian names. So I'll stop there. That's an overview of my position on global markets at the start of the new quarter. And I'm happy now to hand it over to questions.
Sure. Thanks, Chris, for your remarks. I mean, you're clearly alluding that the central banks have overdone the panic in the wake-up of the pandemic, and a lot of money has got printed eventually because of all this. So, I mean, one question that comes to the mind is, how long can this whole Fed-induced, central bank-induced rally in global equities continue? Whether this rally is actually backed by fundamentals? Do you really see a bubble getting created in global equity markets? And what is the end game to all this? How is this all going to end?
Well, I don't think there's a bubble in Asian equities because I don't think Asian equities are a crazy valuation. So when it comes to Asia, Chinese equities are certainly not a crazy valuation. So if there's a bubble in equity markets, the bubbles in the U.S., in the FANG stocks, etc. But on the other hand, the FANG stocks business models have been supported by the lockdowns. Now the reality is that the market thinks let's say I'm wrong. Let's say we have a big second wave in America. Let's say there's a second wave in New York. That would really hit the markets because the market's based in New York. Then we get a big sell-off, but the market now thinks, because the Fed has now said it will buy corporate bonds, and even last quarter said it would buy corporate bonds which are being downgraded to junk level, as well as buying selected CLOs. Now the Fed has basically conceded that principle. At the back of its mind, the market now thinks the Fed, if it's necessary, will buy everything and anything, including equities. So you have to understand, that conviction is now supporting equities.
Right. Chris, this is Siddharth here. You mentioned you don't see a bubble in Indian equity markets. But, I was reading your memo, and there you highlighted how, when we look at the unemployment benefits in U.S., that's almost gone up by $600. And you also quoted a research by University of Chicago, which mentioned that 68% of the temporarily unemployed people, they are earning more than what they were earning before. In that context, when you look at India, we have not seen any, consumption-related stimulus. And but while when you look at the Indian markets, they behave almost similarly to developed markets. So what's your thoughts on the same?
Yeah, well, that's a very good point you raised. So look, on the U.S., that's a very important point. The rise in the unemployment benefit has been huge, and it means that many people are now getting more in unemployment benefit than they would get if they return to their job. Now, technically, the unemployment benefit is meant to be reduced back to the old level at the end of July.
Yeah.
So a very important point is, will this happen or won't it happen? Technically, the Republicans want to put it back to its old level. The Democrats want to keep it. Obviously, but obviously there's a possibility that they keep it at this level. If they keep it at this level, obviously that's good for income growth, but it's reducing the incentive to work. Now, if they put the unemployment back to the old level, which means they basically get paid $600 less, under the scheme where they're lending money to small companies in America, those loans will be completely forgiven if the companies rehire the temporary laid-off employees.
Right.
So there is a scenario where the unemployment rate in America can drop dramatically because all these temporary laid-off people will get rehired because of this program.
Sure.
But if they don't, they don't put the unemployment benefit back to where it used to be, then they may not have the incentive to be rehired. So that's just something we need to watch. That's going to be a very important point. On India in the short term is just following the markets. But in my view, the biggest negative in India when it comes to COVID-19, well, the biggest negative is that COVID-19 has spread in India because the lockdown in India was extremely sudden and aggressive, and it seems to have induced quite a lot of panic movement, and it hit a lot of day laborers. So in my view, the economic damage of the lockdown was pretty substantial, and it came at a time in India when the Indian economy was already very weak. So to me, the lockdown was a big negative in India, but equally, the fact that the government then did in my view, the current Indian government has done a total U-turn because of reopened the economy, although the cases are still rising. But personally, I think that was the right policy to take, to reopen. But you don't begin to have the same welfare schemes in the developing countries like India. So the lockdowns are way more damaging in the developing world than the developed. But you don't have and the other thing in India, you've got all these loans, you've got all these moratoriums. It's not just India, all over the world, you've got moratoriums on borrowers and lenders. So for anybody investing in equities, particularly bank stocks, it's very tricky because in the short term, all these moratoriums will make all the loans look okay. But in the long run, the question for people who own bank stocks is, will these moratoriums keep being extended?
Right.
So personally, I don't like it. To me, bank stocks are risky because the risk with all these policies globally, it's a bit like QE. When quantitative easing was originally introduced, I believe in 2008, it was meant to be temporary. The Fed is now doing unlimited QE. So the risk is that these moratoriums, don't prove more than temporary. This is the big risk of a lot of these policies which have been announced.
Chris, in that backdrop, we have also seen two moratoriums of 3 quarters each. We already 3 months each, and we already have 2 moratoriums, and there's also a talk of a third moratorium coming in for the next 90 days. Indian banking NPAs, banking system NPAs, S&P has just very recently said it could rise to 12.5%, 13%. How do you see the Indian banking?
Sorry, I missed that. Sorry, who said that?
I'm saying that...
S&P, the credit rating, yes. Yeah, so listen, I'm personally on India. I have a long-only Asia ex-Japan portfolio. Which I started in 2002. I've always had a weighting in Indian private sector banks in this portfolio. But last quarter, and I frankly should have done it a bit earlier, I removed all the Indian banks in my long-only portfolio. Because to me, the risk here for India is that we now get an NPL cycle in the consumer loans. So in India, the Modi government inherited an NPL issue in all the corporate infrastructure loans. They took too long to address this, but they did finally those loans were finally accounted for. But then we had the NBFC liquidity squeeze blow up, and NBFCs who were first generation can no longer get funding in the bond market. So the NBFC lending growth rate collapsed. And that clearly put stresses on the NBFC housing finance company sector. So we had an NPL cycle there. And the risk right now in India is that we have the first consumer lending NPL cycle, I would say, probably since, I believe, maybe the late 90s. So that's my concern on India right now, and for India Pacific. But part of this is going to be determined by whether, how long, the devil's going to be in the detail of these forbearance policies. Yeah. In terms of how long they last, how they're implemented. I'm not on top of the exact details. But I'm not surprised to hear that the credit rating agencies are, signaling concern. And I'm also not surprised to read that banks are raising capital, taking advantage of the equity rally to raise capital, because the banks won't know the exact situation themselves, because they don't know how long the moratorium is going to last.
Sure. So you have gone massively underweight on the banking sector in India.
Yes.
That's what you're saying.
Sorry?
You have gone massively underweight on the Indian banking sector is what you're saying.
No, I don't own any Indian banks, because I've got 25 stocks in Asia. I don't need to own Indian banks. I could have frankly got rid of them, a month earlier. Yeah, I do have Indian insurers, which I think is a good long-term story. Now, there's a possibility this is a great buying opportunity in Indian banks. But I have not been able to be in India since last December. I'm too far away. You don't need to own an Indian bank. You don't need to own a bank anywhere, actually. So personally, to me, a more straightforward story is owning, if you own a car, if you buy the two-wheelers, if you believe the economy is reopening and cyclically it's got as bad as it can get, then to me, a more straightforward story is to buy a play on two-wheeler sales, or to invest in an Indian car maker, rather than a bank. Because the banks are going to be very sensitive to the exact details of these forbearance policies.
Yeah.
So the risk, if you own an Indian bank, is that the banks are made to do social service. That's the risk.
Yeah. So, Chris, before we get into the the domestic and portfolio side, just one more question on the global side. In your remarks, you did mention that you think the US-China thing is exaggerated. But there is increased chatter and even things happening on the ground which suggest shift in supply chain. In this context, what's your thought on the implications for this region, and do you think India could be a beneficiary from this trend?
Yeah, look, there is definitely, production is being moved out of China. That's true. But it was already starting because of the Trump tariffs. But the trend will get more momentum because of COVID-19. Because COVID-19 and the lockdowns highlighted the risk of extended just-in-time supply chains, and it made people realize it was risky producing everything in one place. However, this is just going to be, so there's going to be a reduction in Chinese production, but you don't want to think that everybody's going to leave China. China is going to remain the world's biggest manufacturer, in my view, for many years yet, because it has by far the best infrastructure, by far the best logistics, and it's also got a massive domestic market, so the companies won't want to leave it. So that's the starting premise. But there will be shifts in production. So far, the countries benefiting from that shift, I would say, are clearly Vietnam. In the technology space, Taiwan, because Taiwanese companies in China are moving production back to Taiwan.
Right.
Also, Thailand and Malaysia. India could benefit.
Yeah.
One second. India could benefit, but so can Indonesia. But they'll only benefit if they get I think we need to see real reforms of labour laws. So my understanding is the more India reforms its labour laws at the state level, the better because India can benefit. But nobody should believe, you can only believe that when you see the evidence.
Got that.
Yeah. And Chris, would like to hear your thoughts on the increased chatter of global supply chains moving out of China and going to other places. In that backdrop, would you think that India can benefit out of this? And what are the developments?
Well, I think that's the same.
Yeah,
but that's the same question I just answered, right?
Yeah.
That's the same question.
Okay.
Yeah. No, but all this is true. But people need to understand though that China's going to remain the biggest. It's all a question of degree.
Right. Yeah.
It's all a question.
Right. So, Chris, then.
Yeah.
Yeah.
Yes.
Yes. Sorry. So,
hello. Can you hear me?
Yeah. Yeah. So I was saying, if we move to the domestic side, so you did in your initial remarks talk about your views, but there has the international investors have often mentioned that India is a place where they've always seen a lot of potential. But perhaps the way the stories played out has not been the way people would have expected it to. So someone who like yourself, who's been looking at India for a long time now, and so what is in your mind lacking, or what are the key reforms that India needs to do that is critical? And if you could kind of just give your the base, the worst, and the best case for the next decade for India.
I know, well, it's quite clear what the best case is in India. What we need to make India a straightforward bull story in equities again, what we need to see happen is what we saw between 2002, 3 and 2010. Because in those years, we had a capex cycle in India, investment cycle, and that led to a very powerful bull market where investment cycle coincided with a big rally in earnings. Interest rates came down, so that was the So if that happened again, I think that would be perfect. The problem right now today is we don't see any evidence right now of a new private sector capex cycle. Although the corporate loan problem seems to have been worked out, which is good news, but we've got this consumer NPL issue. So I would say the best thing that can happen in India right now is that my concerns about a consumer NPL issue prove to be wrong. There isn't a consumer NPL issue, and that would be very good news. Then I would hope that the residential property market, which has been in a downturn, I believe, for 7 years, and has been going through the mother of all consolidations because it's been hit by a series of shocks, be it demonetization, be it RERA, be it GST, be it most recently COVID-19. So I would hope that the residential property cycle bottoms and that starts off the beginning of a new investment cycle. So that's what I'm hoping. But that will all be delayed if my concern, so to me, a key short-term issue is consumer NPLs. I think the manufacturing story and taking advantage of production moving out of China is certainly a possible story. But my understanding is that labor laws in India are a state matter, not a federal government matter. So I think that's the state specific. But I think the last government did do a lot of structural reforms, like the Bankruptcy Act and RERA, which in the long run, I believe, should pay off, yeah. So, I'm still, long term, I'm still positive, yeah.
Chris, in that backdrop, now that
that answers the question.
Yeah, somewhat.
Yeah.
Thank you. Yeah.
Chris, now the ruling government will have a majority in the upper house of the parliament soon. Would you say that if, labor reforms get introduced in India and, that would lead to a serious re-rating of Indian markets in the eyes of, from the foreign investors' point of view? Is that a real possibility?
Well, no, that's not going to cause a re-rating, but it will definitely make people more positive. But I think for now, what causes a re-rating would be if people get the sense that I think the most immediate short-term issue in India is this consumer NPL issue. There's either an issue or there isn't.
Yeah.
Because if you have a problem in the banking system, it delays the recovery. And the problem of all these moratoriums will make that harder to identify. Yeah.
And Chris, we would like to hear your thoughts on how real is the risk of a sovereign downgrade for India. I mean, we are already at BBB minus, just one notch above jump.
Yeah, well, I'm hoping. Well, I shouldn't emphasize. I'm more primary equity rather than fixed income. But I would say that the Indian bond market has been behaving pretty well this year in the context of the policies announced, and I believe there's been quite a lot of foreign selling of Indian bonds. But I also believe that the RBI has not engaged in direct monetization. Correct me if I'm wrong. So I wouldn't expect an imminent personally. Now, sure, the fiscal deficit expanded in India, but on a relative basis, actually, because the Indian fiscal deficit was already high.
Yeah.
So on a relative basis, what the Indian government has announced in terms of fiscal easing is actually much less than what US has announced, or what Europe's announced, or what the UK's announced, or what even Singapore's announced. Singapore's announced the most enormous fiscal easing. So on a relative basis, I don't think India is so out of line in terms of the fiscal easing.
Right.
But the point is, India already started with a high fiscal deficit.
True. Yeah. So
I get more nervous about the sovereign credit rating and the currency if the Indian central bank starts to engage in explicit monetization, which my understanding is it's not doing. But correct me if I'm wrong.
There is talk of they getting aggressive on that, and I think maybe the COVID had pushed it. So I think that's very much. I think there was a recent announcement, a remark by one of the government functionaries with regard to the accelerating on divestment side. So I think that's very much on track. So hopefully,
right.
You should hear on that soon. Yes.
Right.
Right. So, Chris, now if we move a little bit on the portfolio side, the one big debate that, we all been seeing for some time now is the debate on passive versus active investing. And, there is a lot of talk that, even in, say, a country like India, ETFs are catching on, and there is a view that maybe we will also move towards the way we have seen passivization of investment in US. So would be great to hear your thoughts on the passive versus active investing and how we likely to see for India.
What, do you mean the development of active over passive, right?
Absolutely, yes.
Yeah, well, personally, I think passive investing is it's obviously become very popular in America. Personally, I think it's a very dangerous trend. And personally, I think it ultimately becomes illogical because in passive investing, everybody buys the same stocks.
Yeah.
So I call passive investing investor socialism. But in a bull market, passive investing can work for a period, and it leads to extreme overvaluation because everybody buys the same stocks.
Right. Yeah.
But fundamentally, it's illogical. Socialism doesn't work, and it doesn't work in investment either.
Yeah.
If I was a regulator, I would not allow passive investing, but I'm not.
Right. Yeah. No, so that's.
Also, I wouldn't allow ETFs either. I think ETFs are a very dangerous, insidious trend.
Yeah.
In theory, they make a lot of sense because they're cheap and efficient.
Right.
But the problem with ETFs is they commoditize the business of investing in equities. They make the equity market like a commodity, like steel or copper, and they create an illusion of liquidity, and it means that people lose touch with what they're investing in, which is real companies.
Yeah.
But I think the ETFs are even more dangerous in debt, because in equities are listed. But in the debt instruments, debt ETFs aim to copy a bond market, but the bonds are not even listed.
Yeah.
But unfortunately, ETFs are very popular because they're cheap and convenient. So I compare the best way to view ETFs and indexing is like fast food. Fast food is cheap and convenient, like McDonald's, but it's ultimately not good for you.
Right.
The same applies to ETFs.
Sure. Yeah. Thanks, Chris.
Yeah, thanks, Chris. So, when it comes to constructing an India portfolio, Chris, I mean, how do you look at it? Is it a bottom-up approach for you, or is it a top-down, or is it a mix of both? What are the major strategies?
Well, I used to look at it by primarily basing my portfolio first and foremost around the private sector banks.
Yeah.
Because it was a very straightforward growth story, which has worked for all the years I had this portfolio, because the private sector banks were taking market share from the public sector banks. Right. So that was a fantastic growth story, very straightforward. Yeah. And it's just a question of working out which bank. So that was my starting point. But now we've got this issue of whether there's going to be an NPL cycle. So if the NPL cycle is over, first of all, I think you have to have a view on the banks, the private sector banks. Yep. In recent years, though, I think you've also had the insurers have become, it's become much easier to buy insurance companies in the stock market. Yep. So I think that's a good long-term story too. Yeah. I think an interesting story now that you need to have a long-term view is to buy those residential property developers you will believe will benefit from the dramatic consolidation we're seeing in the property market.
I see. Okay.
And then, but more recently, I've had, you're talking just India, right?
Yeah.
Yes.
But I also would I would want to add to the cyclical component in recent months. So there I'm willing to own things like auto stocks, even oil stocks.
Yeah. You don't really are a proponent for the consumer staples or, let's say, the healthcare or the pharmaceutical sector. How would you look at these two sectors?
Yeah, well, I'm not an expert on pharma. I do have a pharma stock, but I think that, pharma and software are the traditional defensive sectors in India when you believe the domestic demand story is not happening. So to me, they're perfectly okay to own. They're kind of like, to me, they're a bit more like they're like a conservative way to invest in India. They're more like the forward defensive. These are cricketing.
And you would believe that we are slightly ahead of the cycle as far as the private capex is concerned. I mean, whatever capex has to come out of the government's balance sheet only. Are you really seeing some because of the massive amount of stimulus that is floating around in the global economy, a revival in private capex in the offing, and maybe markets wanting to price that much in advance? Do you think anything of that is going to play out?
No. Well, to me, the capex cycle in the recent past has been almost totally driven by the government, yeah?
Yeah.
So I think the best hope for a capex cycle is in the housing sector, yeah.
Right. Great. Thanks. So, Chris, if I read your latest memo also, there you talk about a barbell strategy where you, as you mentioned that the cyclical, just the way they've done well in the last quarter, could continue to do well. But you have mentioned that you should, at the same time, continue to be positive on some of the high P and high growth stocks. So, in that context,
because my view, but if you see, my view is if you get monetary V-shaped recovery expectations,
right.
My view is the market will start to worry about timing, but then I'm expecting the Fed to fix the bond yield. I'm talking more in a U.S. standpoint.
Absolutely, right. Right, I get that. But my question on that context was that, increasingly there is stock that, that if you look at the last 3 to 5 years, there's been hardly any earnings growth in India, and most of it has been P multiple expansion for many of the companies. So, just wanted to hear your thoughts on the role of liquidity in valuation. And do you think that?
That's a very valid. That's a very valid concern. Now, listen, my overweight in India is dramatically lower than it used to be, precisely for the reason you highlight.
Right.
Yeah. No. And so, actually, in an Asian context, it's made much more sense in the last year and a half to be overweight China, and it's much more backed by earnings, and it started off with much lower valuation.
Right.
So for us to really hope for a real re-rating of India based on fundamental earnings driver, that's why I think we need to see a capex cycle. So that's what's missing. Now, I think what's helped the Indian market maintain valuation, helped the Indian market not derate more, has been the domestic fund flows into the equity mutual funds.
Right. Even that seems to be tapering off a bit. I mean, that's come down quite sharply.
No, it's come down, but it could have gone negative.
Right. Yeah, true.
I mean, Chris, the last, macro question as far as India is concerned, how do you really look at the Indian currency, INR, for the next, let's say, 2-3 years? And how do you see inflation playing out in India over the next couple of years?
Well, I'm a little bit. I wasn't worried about inflation at all during the first Modi government, because I actually had a similar view to the Modi government that the RBI was too tight, that you had too high real rates. So that to me, that was a negative for Indian equities and a positive for Indian bonds and the currency. So but that's the history. Now the central bank has eased obviously significantly. So I think there is a potential risk to the currency. Most particularly in a world, if we get a V-shaped recovery and global oil demand returns in 2021 to where it was in 2019, then oil can rally a lot.
Right.
Sure.
But the reality is the Indian issue with oil is not all negative, because you have a lot of remittances from the Middle East, right? So,
right.
I think the key issue on the currency is we don't want to see the central bank doing aggressive monetization. That would make me nervous on the currency.
Sure. So we are almost out of time, Chris. Thanks a lot for your time. It has been a pleasure interacting with you. I think our audience would have also loved it. Thanks a lot.
Thanks a ton, Chris. This was very insightful.
Thanks.
And
Thanks
thanks so much
very
for your
much.
time.
I heard the line. Okay,
No,
thank you very much.
no
Thank you
problem.
so much.
Thank you. Okay,
Thank you.
Thanks.
bye. Bye. Bye.
Thank you so much, Chris, for the wonderful insights and interesting perspectives. Thank you so much, Siddharth and Manish as well.